Greetings, Dr. Scott here, and I'm glad you're here. We're ready to rock and get going with debits and credits. We're also going to use AI's study and learn mode, which can be found in GPT. Gemini also has a version. I know we've talked about Notebook LM on previous videos. Those are all tools that can help you study and get ahead on the material and practice with it. But first, I'm going to just do a debit and credit overview, and then we're going to go directly into AI to assist us in the learning process. So let me go ahead and share my screen, go on to the whiteboard, and when the whiteboard comes up, we'll set up a new whiteboard and go from there. All right, so let's talk about what debit and credit really translates to. And if you look at the actual word debit, the only logic is left. Credit, again, logically would be right. That's the only thing that's going to make sense out of the gate. If you think about it, you say credit card. The bank is crediting my account. Or are they debiting my account? Or is it a debit card or a credit card? You'll get confused. So we just start with that left and right ideal. So I'm going to go ahead and let's take a look at, let's go ahead and change the color. We're going to go in and make some T accounts. I like my T accounts, and hopefully you will too. We're going to go with our balance sheet of assets, liabilities, and equity. You might have seen this before on other videos or in my classes. And I put assets and expenses on the left for a reason. I put liabilities, equity, and revenue on the right for a reason, because those things on the assets and expenses normally have a left balance, also known as a debit balance. The right side, like liabilities, equity, and revenue, normally have a credit balance. So things like cash will show up as an asset. And we'll put it over here, and we'll put some other assets down here. We'll have cash, and we'll have maybe accounts receivable, maybe we'll have inventory, maybe we have prepaid expenses. And you say, wait a minute, that has the word expense in there. Doesn't that go on the income statement? Not a prepaid expense. The assets are those things we own and we can convert actively to cash. We can sell them or use them up. I'm going to go ahead on my liability side of the house. I'm going to create some liabilities for our use. And we're going to have accounts payable. We might have notes payable. We probably can have some unearned revenue. And now some of you might go jumping and say, wait a minute, I see the word revenue. And isn't that on the income statement? Well, it is when we earn it, but it's not, and we don't have it. And on the equity side of the house, we can go ahead and put in, I want to put both capital accounts for sole proprietors. I'm going to put stock, common stock, and additional paid in capital, APIC for corporations, but then I'm going to put in, I don't have a drawing account, I have a retained earnings account. I like using retained earnings. That kind of highlights, if you can spell right, retained earnings. And we talked about before the retained earnings formula. So when we look at this, we say we've got things, assets, liabilities, equity. And if we left something here like cash, let's have an initial investment of, so we'll put $20,000 into the business. We'll attract some capital. We'll put $20,000 in capital. Let's see if I can expand that. And just put dollar sign 20K under cash. I'll go ahead and put 20K. Here, 20K. Now that is a form of a real entry of one side and the other. My balance sheet's in balance. I've got 20,000 in assets, 20,000 in equity, and 0 in liabilities. So let's do that in a journal entry format. And let's do proper form, because debits will always come first. And we can go saying, oh, I'm going to go ahead and debit my cash for $20,000. And then I'm going to credit, notice the indentation. I'm going to credit the capital account. I could do common stock or anything else appropriate, also for $20,000. And you say, oh, that's all there is to a journal entry? Sure. Well, does cash always get debited because it's on the left side? Probably not. If you can think about it, you say, wait a minute, cash does go up, cash does go down. So let's buy some inventory and we'll go through this and let's get $5,000 worth of inventory. So I always recommend starting with the money. So if I'm going to start here, I'm going to say I got to debit 5,000 and I got to credit 5,000. Oops. And we'll do that with the debit and the credit. Now, what's going to be debited? What's going to be credited in this case? Well, 5,000 is coming out of cash. So I have to credit my cash to reduce that to 15, don't I? So let me go back here, credit my cash. And what am I debiting? I'm going to debit my inventory. Okay, nothing fancy, just straightforward, two-sided journal entry in balance, keeps our balance sheet in balance. This resulted in a net change of my assets of 0. My assets didn't change at all because my cash went down to 15,000 and my inventory actually went up 5,000. So there we go, debit, credit, and we're keeping in balance and life is good. So what's the next step? I want to go ahead and I want to sell something. Now, when I sell something, I am going to be putting out, well, let's see, actually, I'm going to put my capital, I want to put it in common stock. I retain earnings because we're going to be reading financial statements. I'm going to go ahead and move that down to my common stock just so we have it pretty and clean. And I'm going to sell some stuff. I'm going to sell, let's say we start a landscaping company. And yeah, we bought some seed and fertilizer. There's our $5,000 worth of stuff. It's not an expense yet. We didn't use it. We didn't sell it. Until we do that, we're not going to move it to the income statement. So right now I have zero, zilch for expenses. But let's say someone comes over and says, I want you to come to our home and give us a landscaping plan and figure out where to put plants. And I'm going to pay you $10,000 for that. So I'm going to go ahead and I'm going to call it consulting services, or what's this? Yeah, that'd be a good one. Consulting revenue of $10,000. And I'm going to go put this over here and not cash. They didn't pay me yet. I'm going to put it as a receivable. They owe me the money. I haven't got it yet. I hope to get it soon. I'd like to get paid. As a matter of fact, I need cash to pay my bills. But right now, it's just a receivable. So if you look at the bottom line, my net income is a total of 10,000 minus 0. Now you notice I increased my assets by 10,000. I didn't change my liabilities. I didn't change my equity. Or did I? Yeah, I guess my equity did change. So where does the equity change? Okay, capital, common stock, yeah. Oh, this retained earning thing. So if you remember, we had a formula for retained earnings. So we need to reinforce that. This is how immediately, right away, just as I get something on the income statement, it jumps right over to the balance sheet instantaneously. It's like a beginning retained earnings. I add net income. I subtract dividends. I get ending retained earnings. And if you notice here, based on that formula, my ending retained earnings is how much? Well, if I have net income of 10,000, 0 dividends, 0 beginning, I'm at 10,000. So am I staying in balance? You bet. That's the art. That's where we want to be. I'm just going to get this on the same line and keep it pretty and make it go. All right, so that is the summary of doing journal entries, of debits and credits, and of making sense of some of this stuff. Let's go a little further. Now you notice I debited cash, I credited cash. I debited inventory, I credited capital, and I'm going to do that sale down here as one more journal entry. And as I say, let's start with the numbers. 10K and 10K. And I go back, I'm saying, let's see, what was I debiting? Now be careful of the words increase and decrease, because notice a debit increases cash and receivables, a credit increases consulting revenue, credits increases common stock. So we can't say increase or decrease. We just say debit and credit, just to be clear. And what did I debit for the 10,000? I debited my accounts receivable. And what did I credit? I went ahead and credited my consulting revenue. Are we on the same page, I hope? Hopefully making sense. It's supposed to make sense. Counting usually makes sense. So if we're looking at that, we say, okay, that's logical. Last transaction I want to do here before I give a big picture again is what are we going to do with the receivable once it gets paid? Can we generate some more revenue on this thing? Well, let's think about that. I sold 10,000 worth of stuff and now I got the money. So I got check in the mail, I got a direct deposit, and may have got a Zelle, who knows what I got, but I got paid. And I got $10,000. And I got the other side of the transaction. Let's go back here. Let's clear that up. Yeah. Okay, so I got 10K. And the other side of the transaction is 10K. So what happens? I got paid. How did I get paid? I got paid in cash. We'll take the money and run. The next question is, what's the other side of that transaction? Well, right now, I'm going to draw a quick T account for your benefit. And you're going to see that we happen to have an accounts receivable that has a 10K debit balance. That was from this entry over here when we sold the consulting services. Now, if I go back down here, I need to go in and say, you know what? I got to clear that receivable because they don't owe me the money anymore. They paid me. So I'm in good shape. Let's go in here and we'll take that accounts receivable and credit the accounts receivable for the $10,000. So I'll put that 10K as a credit. Now they don't owe me anything. Notice I did not record revenue twice. I couldn't credit revenue again because that's not my revenue. I could only debit the cash, which I got, increase my cash to 25, and reduce my receivables to 0. And we'll edit that accordingly. We'll go in, take a look at the entry, and we'll zero out our receivable, and we'll add 10,000 to our cash. So we stay in balance, and life is good, and that's the way we want it. Actually, I did say I had one transaction. Let me do one more transaction. Let's say we sold some fertilizer. We got a bunch of inventory. We got 5,000. We sold $1,000 worth of fertilizer. That cost us $500. That we got however many bags, and we got however many pounds of fertilizer. We spent $5,000. The retail value is $10,000, but it cost us $5,000. So our cost goes in our inventory. But now that we're selling it, we not only go from double entry accounting to quadruple entry accounting, which is 4 times as fun as double entry accounting. So how do we do that? So let's say we sold $1,000 worth of fertilizer. So I'm going to make 2 entries here, one for 1,000 and one for 1,000. And that's going to be 1,000 debit and 1,000 credit. The catch is I also need to record my costs. I sold it for 1,000, but it didn't cost me 1,000. So I can't pull 1,000 out of inventory because it only cost me $500. I can't go ahead and say, well, transfer 500 in expenses to the expense side for cost of goods sold because I don't see that 500 there, but I do need to put 500 and 500 on my accounts. So for a transaction or a sale like that, we need now 2 entries. And by the way, you can have multiple debits and multiple credits on one entry. You don't need to have 1 and 1. but we'll do it for now. So what do I get for $1,000? Well, how do we have, I think in this case, we have an asset going up and revenue going up. So what counts are going to get hit? I think with counts that we're going to hit here, is it a receivable or did we get cash? Well, let's say we got cash. I always like cash. Okay. And another count we know is going to get his inventory. We also know that, we got to hit the income statement, 2 places. One's going to be revenue. And the third is something called cost of goods sold. COGS or cost of sales or cost of product sold, a whole bunch of names. So now that we know what 4 accounts are going to get hit, we can go back and put them together in our adjustments and say, okay, what are we debiting for $1,000? Well, my vote is going to be to debit cash. Cash is up $1,000. But what do I credit for $1,000? Well, credit, I'll call it, fertilizer sales. So I've got a fertilizer revenue, either or. You can all kinds of names for things. So that's cool. 1,000 up in revenue and 1,000 up in cash. Right away, my retained earnings is also up $1,000, just because my net income's up $1,000. All right, so we're still in balance, 1,000 up, 1,000 down. But we didn't make $1,000 on this deal. We made $500 because we had $500 in expenses, which we are going to debit the expense and credit the inventory. We're going to reduce the inventory by 500. So let's do that. So I'm going to go back in. I'm going to take my cost of goods sold as a debit, and I'm going to credit my inventory. Now notice that the cash was debited. Cash is up $1,000. Cost of goods sold is debited, up $500. My revenue is credited. That's up $1,000. My inventory is credited. It's down 500. But our balance sheet stays in balance all through the wash, through the retained earnings account. So this is demonstrating that, we've got some accounts we got to be concerned with and got to worry about. So let's get some bigger rules here. Because the key is, how does it all fit together? You either need to look at the picture up top and know that normally you're going to left the assets, normally left the expenses or debit them. Normally you're going to write the liabilities, write the equity, and write the revenue. But you notice like cash went debited and credited for different transactions. So the key you need to memorize the picture or follow the following rules. The rules are increase in asset, debit, abbreviated DR, decrease asset, credit. On the other side of the balance sheet, increase liability is a credit, decrease liability is a debit. Increase equity, I can say that 5 times fast. Increase equity is a credit, decrease equity is a debit. And then I go over the income statement. I want to increase revenue. And let's see where revenue at. Now, it's on the right side. So I got to credit that if I want to increase it. So increase revenue. I'm going to credit. Decrease revenue. I'm going to debit. Increase expense. That's up on the left side. If you recall, expenses on the left. That's a debit balance typically. So increase expense, debit. Decrease expense, credit. Now, I will say there are some things called contra accounts. There's something called accumulated depreciation that offsets your equipment. On the revenue side, you have a contra revenue account, like debit balance for returns and allowances or sales discounts. We'll talk more about those down the road. So there are some contra accounts or offsetting accounts. But the key understanding is debit and credit means left and right. All right, let's go ahead and I want to go into AI and talk about, we're going to cut that out. No, you don't need a link for that. I'm going to stop the share. Right there, kill it. And now I'm going to go into ChatGPT. I'm going to talk about study and learn mode. And study and learn mode is kind of cool. So I'm going to be here and I'm going to jump in. Let's see. Let's jump back in. I need to stop on my screen so it doesn't get in the way. Sometimes this bar, the floating meeting controls gets in my way. Okay. So I'm on ChatGPT. Now, if you have the paid version, you're going to have the instant mode, thinking mode, and then you have a bunch of legacy models. I usually leave it in thinking mode because that's where I want it to be. And then there's a standard and extended. If you're free, you're just standard, but I'm on standard, which is fine. Add photos. I'm not going to go to my Google Drive. I'm not creating an image. Deep research is uber powerful, very cool. Go out to the web, back and forth, ask its own questions, answer its own questions, really helping. Do some shopping. Agent mode's kind of neat. If you're in the free mode, you'll see the study and learn on that first window. I'm going to go ahead. By the way, Zillow's, LinkedIn, you have Canva, I've got quizzes and other things that you can create from here. I'm going with study and learn mode. And I'm going to have it tell me, no, I'm not going to do any fancy prompting. Tell me about debits and credits. As I am a college student in my first accounting or second or third, and in my college level accounting course. Let's see what it does. Let's see how it explains it. See if it helps clarify anything that might still be confusing as we go. Before I jump in, okay, it's asking what level principles, managerial, accounting equation, how claim very understandable debits and credits. Okay, here's a clean way to understand debits and credits. Let's expand a little bit. Core idea, don't memorize debit good. Debit good, credit bad. No, 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 no. You know that, cash going down is fine. You're spending money and doing that's good too. So debit means the record an amount on the left side of the account. Credit means the right side of the account. I think we heard that before. Journal entry, all total debits must equal total credits. And what matters for each account type, which side increases it. So we get 5 account types and 2 groups. Debit, assets, expenses, dividends. These go up with a debit, down with a credit. And I gave you the chart. Again, I gave you the picture. Liabilities, accounts payable, loans payable, common stock, retained earnings, revenue, go up with the credit. Okay. Dead click, that's a memory aid. Debits, expenses, assets, dividends, credits, liabilities, income. Okay, not a bad mnemonic device. Creative way of trying to memorize that stuff. Connected to the accounting equation, the Y. Here's our assets equal liabilities plus equity. So if an entity increases assets, left side, something must increase on the left or the right to keep the equation balanced. Debits and credit, the bookkeeping mechanism. Okay, tiny practice. Tell me whether each is debit or credit. So it's going to test you. The nice thing about study and learn mode, it's a Socratic method. It typically will not give you a direct answer. You can put a homework problem in there and it'll say, let's talk about it. Let's work it out together. And I encourage you to use this for testing purposes, for studying purposes, for review purposes, before you take a quiz, before you take an exam, even before you come to class to see to clarify, or maybe to bring out some more questions that we can talk about in classes or in extra sessions. If you give me a shout, if you need some help or whatever we need to do, we'll get you up and running and getting in where what this stuff is. So tell me whether each is a debit or credit. Receive cash from a customer for sale. What is cash? And what's sales revenue? So let's see, cash equals, so what do we say? Is cash, you receive cash, cash is increasing. I believe that chart had cash on the left, increase of cash, increase in asset is a debit. And shift return, by the way, gets you to the next line when you're responding to something like that. And I'm going to go with sales revenue. As a credit. Now, did they both go up? One go down, or what happened? Cash went up. Thank you very much. Assets up. Sales revenue went up. Net income went up. Equity went up. all from acting with that sales rev example. See what it takes, see if it likes that. Correct. Now let's look at the reasoning so you can reproduce it under pressure. Cash and asset increases debit. Sales revenue increases credit. Debits equal credit, so they balance. One step harder, the same concept. A customer buys 500 of services on account. They will pay you later. So it's not a cash transaction, it's a receivable account transaction. The revenue still gets credited, but wrong hand. We get credit to the revenue account. We're going to debit not cash this time, but what are we going to debit to? We're going to debit accounts receivable. So let's go ahead. Yep, self so far. Thank you very much. And let's go with that up. So we say we're going to debit receivables or credit. I thought we said debit. Let's see if we do it wrong, what it gives us. I'm going to think for a minute and say, why'd you give that answer? Because you guys, I bet every one of you is looking at me saying, silly, it's a debit. Okay, good attempt. Very common spot to flip it. Accounts receivable is an asset. When a customer owes you money, your assets increase. See, accounts increase, so accounts receivable, debit, credit. And I'm going to say, down accounts receivable up. We'll try debit. See if it gives us the kudos and says, well, correct. You finish the entry, customer buys 500 service on account. It's service revenue, debit, or credit. I'm going to put in service revenue credit. See if it just takes the C. Reinforce the pattern here, two quick spot side items. You pay rent, same what is cash, rent expense. We debit the rent expense, we credit the cash is down. Could you provide a chart for review? Yeah, here, exam safe chart. You can keep open when practicing. There's that summary, debits, credits. If you want, we can turn this into a 60-second drill. I would encourage you to do that. I give a transaction, you'll tell me the two accounts and whether it's debit or credit, one at a time. See if it'll give me an infographic. We'll give it a little step higher and make it do some work for us. So hopefully you're getting you to feel that debits and credits are not to be allergic to. You don't have to shy away from them. It's just getting in the right category. Always have to balance. That's the nature of debits and credits. We're in a position where we can make these entries. And we're going to be jumping into accruals later on, jumping in and saying, okay, well, we need to make some adjustments at the end of the month and accrue things. But let's see if they get a nice picture for us and can explain visually what debits and credits are going to look like. And you can do this if you're ever preparing presentations, you're doing PowerPoints, just ask it for an infographic. Ask it for a chart or diagram. I'm going to do some prompt engineering things in the future, but I want to make sure you don't have to get too fancy. You just have to get an idea of what you're looking for. And even if you're writing papers, don't have it write the papers for you. You write the draft, right? If you say, give me a resume, it'll give you a resume, but since it doesn't know you, it'll give you junk. If you give it a decent resume to start, a reasonable resume to start with content, it can tidy it up. It can place things, make it look cleaner, easier, understandable. All right, so debits increase, credits increase. Here's a picture of what they're drawing. I like my T accounts personally because that's just a simple, easy picture to draw. If you ever take quizzes and tests, you can always on a blank piece of paper write down 2 T accounts: assets, liabilities, equity, revenue, expenses, and you're back in business. So this is their picture of debits and credits explained, and pretty clean. They like the dead click mnemonic device. And there we have it. So yeah, use study and learn mode. That's a pretty powerful tool to have in your toolbox and be able to go with. On that note, I will conclude our discussion of debits and credits. If you have any questions, don't hesitate to reach out. You are welcome to call me directly, email me directly, or otherwise get in touch or set up a time that we need to get together. Look forward to bumping into you again soon. Thank you so much. Take care.